One of the most horrible things ever is paying taxes. You already struggle to pay for necessities like food and utilities each month. The last thing you need is to worry about paying your taxes on top of that. As a result, you probably began considering ways to pay less in taxes overall so that you have more money at the end of the day. Let's investigate how to reduce tax payments. Is it possible to reduce what you pay in taxes? Every taxpayer desires to pay less in taxes. Some people might even think it's impossible, but fortunately there are steps you can do to reduce your tax burden. Your tax burden can be much reduced, but you must be more diligent in your tax planning. Don't worry, even those with high incomes can use these strategies to ensure that they no longer pay excessive taxes. Welcome to our channel, where we discuss all things money and finance. From expert tips on saving and investing to the latest news and trends in the financial world, we've got you covered. Whether you're a seasoned investor or just starting to take control of your finances, our channel is the perfect resource for you. So join us by subscribing below as we navigate the world of money and learn how to make the most of your hard-earned dollars. How to reduce your taxes legally. Absolutely, you can reduce your taxes. Nobody likes paying large amounts of taxes, let alone dealing with unforeseen tax obligations that derail all of their preparations. If you fall within this category as well, you need to take action to reduce your tax obligations. Here are some 6 steps you may take to reduce your tax obligations and save money in the process. 1. Make retirement account contributions. Your taxable income is decreased and your tax burden is decreased when you make contributions to your employer's 401k or other eligible retirement plan. 401k investments grow tax-free up to the time of retirement withdrawal. You'll benefit even more if your employer matches your retirement contributions. In 2022, you may write off up to $20,500 or $27,000 if you're over 50. Further choices consist of putting money into your own individual retirement account. IRA is an effective way to save for your retirement and reduce your tax liability. IRAs offer tax advantages such as tax-deferred growth on contributions and tax-free withdrawals in retirement. You can contribute up to $6,000 per year to your IRA, and those over 50 years old can make catch-up contributions up to $1,000. It's essential to start saving early and consult with a financial advisor to determine which type of IRA, traditional or Roth, is best for your situation. By putting money into your own IRA, you're taking a proactive step towards achieving financial security in your retirement years. 2. Add money to an HSA or FSA account. Using a flexible spending account, FSA, or health savings account, HSA, you can use pre-tax money to pay for out-of-pocket medical bills or costs associated with caring for dependents. Your company may provide you an FSA. Depending on the FSA type, you may be able to utilize funds to cover dependent care, eligible medical expenses, and certain vision or dental charges. For those who qualify, high-deductible health insurance plans are HSAs. Your own HSA can be created and funded with pre-tax money. You won't pay taxes on eligible withdrawals, and your money will grow tax-free. 3. Claim self-employment tax deductions. Track your business expenses throughout the year if you've begun doing contract work or freelancing, including home office costs, business usage of a vehicle, business travel, supplies, equipment, and advertising. You can claim a deduction for eligible business costs on Schedule CE of your tax return during tax season. You may also be eligible for a 20% pass-through deduction in addition to being able to deduct half of the self-employment tax you pay. You cannot subtract money you receive from your job from these deductions. Also, you should save copies of any receipts and credit card records for any expenses you deduct in case an audit occurs. 4. Find tax credits. Because tax credits lower your tax bill dollar for dollar rather than lowering your taxable income like tax deductions do, they are sometimes even better than tax deductions. A variety of tax credits are available from the federal government, including Child Tax Credit. While the American Rescue Plan Act's increased child tax credits were set to expire in 2021, standard child tax credits of up to $2,000 per eligible child are still available. Child and Dependent Care Credit. You might be qualified for a child and dependent care credit to help with the costs if you pay for child care or provide care for other qualifying dependents. Credit for Earned Income, EITC, for taxpayers with low and moderate incomes. The Earned Income Tax Credit offers relief in the form of a refundable tax credit. Depending on your income and family size, you may be eligible. American Opportunity Credit. For each student they're sending to college, parents may be able to claim up to $2,500 in tax credits, 100% of the first $2,000 in qualified expenses, and 25% of the second $2,000. Income and eligibility restrictions apply. Plug-in electric drive car credit. As long as the vehicle manufacturer's eligibility hasn't phased out, you can obtain a credit of up to $7,500 for the purchase of an eligible electric vehicle. Credit for residential energy-efficient property. A tax credit of 22% to 26% of the expenditures involved with installing solar electric property, solar water heaters, geothermal heat pumps, small wind turbines, fuel cell property, and eligible biomass fuel property may be offered. 5. Contribute to charity. You can deduct charitable contributions up to 60% of your adjusted gross income if you itemize deductions on your tax return. In other cases, it might be less. For more information, see IRS Publication 526. Donations must go to organizations that qualify as charities, such as the American Red Cross, churches or synagogues, veterans organizations, nonprofit schools, and hospitals. Non-reimbursable costs that you accrue while volunteering for a charity that qualifies can also be written off. By giving stocks or other investments to charities directly rather than turning them into cash and taking the gain yourself, you can also avoid paying capital gains taxes. 6. Subtract medical costs. When out-of-pocket medical costs total more than 7.5% of your adjusted gross income, they are tax deductible. These costs may include, but are not restricted to, payments to medical professionals, including those in the fields of dentistry, surgery, chiropractic, psychiatry, and psychology. The price of prescription drugs out of pocket. A guide dog or other service animal, prescription eyeglasses, contact lenses, hearing aids, crutches, wheelchairs, dentures, or other medical equipment. Travel to and from medical appointments. It's essential to keep accurate records of your medical expenses and consult with a tax professional to ensure you're following the proper guidelines and taking advantage of all available deductions. Conclusion. Reducing your taxes legally requires careful planning and attention to detail. It's crucial to consult with a qualified tax professional to understand which strategies work best for your situation and to ensure compliance with tax laws. Remember, reducing your taxes legally can provide you with more financial freedom and flexibility to achieve your goals.